Move on. The Federal Reserve is expected to cut interest rates today, and we are likely to get another interest rate cut in December. John Lonski joining me this morning. Okay, two interest rate cuts, November, late October and December. Is the Fed doing the right thing?
I think they are right now. You know, these rate cuts are in response to a weakening labor market, a labor market that's showing next to nothing in terms of jobs growth.
Will it help the labor market?
Over time, perhaps. It's a strange situation we have right now. A lot of these big corporations are not hiring people because of AI, and also because they overhired some years ago, just following COVID. It wasn't that long ago that when we had fears of labor shortages. Those fears have disappeared, and these companies find they have more people than they need in certain occupations.
Okay, we get two rate cuts later this year. Going into next year, we've got the tax cuts kicking in. We've got less red tape kicking in for corporations. We've got a lower corporate tax rate. Do we have an economic growth rate at some point next year of 4%? Because that would really solve the labor market problem, wouldn't it?
Wow, that's quite a stretch. What bothers me is this lack of jobs growth may eventually feed into consumer spending, and we're not going to get perhaps the consumer spending we need to support 4% economic growth overall. That would worry me. And, there is some investment, as you said, because of the tax cuts, you get more investment spending. But are companies necessarily going to increase capital spending if their sales are flat to lower? No.
Well, okay. You don't think we're going to get 4% growth?
I'll tell you, the consensus estimate is 2%, one half of that.
And you're going to stick with that?
I'm going to stay with that 2% growth rate right now. I don't see it happening until I have reason to expect an acceleration of jobs growth. And believe it, I just don't see that happening.
What about inflation? We're roughly 3% right now. Does that stay at 3%?
It does over the near term, and the hope is that with a slowdown by consumer spending, we get a buildup of unwanted inventories. We underutilize capacity in consumer services, so companies might actually be forced to start cutting prices later in 2026, despite tax cuts.
All right.
And despite lower interest rates.
If we get 2% growth, as you absolutely insist that we will, and inflation comes down a notch or two and rates are down, is that good enough to sustain a stock market rally?
Yes, I think it will be, because you want to get rid of the stock market rally, you've got to get a contraction of earnings. I don't see that happening, and 2% growth is not a recession.
You see, you're putting out now, I prompted you to give me a rosy forecast for the future. The stock market rally holds, we get 2% growth, lower inflation. Whoop-de-doo, that's pretty good.
Right, not bad.
So what are you complaining about?
You have to own stocks. Who cares if you lose your job if you can't find a job? By the way, the unemployment rate for those young people, 20 to 24 years of age, is greater than 9%. That's scary.
Bad. Okay. But what you're ignoring is the wealth effect from the stock market rally.
And, that keeps things
$7 trillion the market's gone up in value this year. $7 trillion. Middle America's got a piece of that. They can use it.
And the baby boomers who hold all these stocks are keeping the economy growing, I suppose.
Don't knock the baby boomers, son.
Right.
That's not right. John, you're all right. Thanks
all right.
so much for being with us this morning.